An economic crisis is a challenge that affects countries around the world, causing profound impacts on various sectors of society. However, there are examples of countries that have managed to overcome significant economic crises and successfully recover. In this video, we will explore some of these inspiring examples, highlighting the lessons learned from countries that have overcome economic crises and found a path towards stability and growth. Japan 1990s. During the lost decade, Japan faced a real estate and banking bubble that resulted in a prolonged economic crisis. To recover, the Japanese government adopted fiscal stimulus policies by increasing public spending and investing in infrastructure projects. These measures aimed to boost domestic demand and stimulate economic growth. Additionally, structural reforms were implemented to open up the economy, increase competition, and improve the efficiency of the industrial and financial sectors. Japan also strengthened financial sector regulation and recapitalized troubled banks to restore financial stability. The lesson learned is that comprehensive economic policies, combining fiscal stimuli, structural reforms, and measures to strengthen the financial system, can help drive economic recovery. Germany early 2000s. After reunification, Germany faced high unemployment rates and a stagnant economy. To overcome this crisis, the German government implemented the Agenda 2010, a package of comprehensive reforms. These reforms aim to liberalize the labor market, reduce labor costs, and promote investments in education and innovation. Changes were made to labor laws to facilitate the hiring and firing of workers, as well as to encourage partnerships between companies and unions to promote wage moderation. Germany also invested in vocational training programs and education to improve the qualifications of the workforce. The structural reforms contributed to increased economic flexibility, improved competitiveness, and boosted employment. The lesson learned is that measures focused on labor market reform and the promotion of education and innovation can drive economic recovery and reduce unemployment rates. Sweden 1990s. In the early 1990s, Sweden faced a severe banking crisis that threatened the country's financial system. To recover, the Swedish government took decisive actions to address the issues in the financial sector. This included the nationalization of troubled banks, separation of toxic assets, strengthening of banking supervision, and implementation of fiscal austerity measures to control the public deficit. Sweden also adopted policies of transparency and financial responsibility, aiming to increase investor confidence and restore financial stability. The lesson learned is the importance of promptly addressing financial sector problems, adopting robust supervision measures, and implementing responsible fiscal policies to restore confidence and ensure economic stability. South Korea 1997 Asian financial crisis. During the 1997 Asian financial crisis, South Korea was one of the most affected countries. To overcome the crisis, the South Korean government implemented a series of significant structural reforms. This included the restructuring of the financial sector, with recapitalization and cleansing of banks, as well as strengthening financial supervision and regulation. The country also adopted trade liberalization policies, reducing tariff barriers and facilitating foreign investment inflows. Additionally, regulations were relaxed to encourage entrepreneurship and innovation. South Korea also promoted industrial policies focused on economic diversification and the development of high-tech sectors such as electronics and automobiles. The lesson learned is the importance of comprehensive structural reforms, trade liberalization policies, economic diversification, and strengthening of the financial sector to overcome economic crises. Brazil recent economic crisis. Brazil has faced an economic crisis in recent years, characterized by a prolonged recession, high unemployment rates, and political instability. To overcome the crisis, the Brazilian government has sought to implement structural reforms. Among the key reforms is the pension reform, which aims to balance the long-term public accounts. Labor market reform has also been implemented to modernize labor laws, making them more flexible and encouraging hiring. Additionally, the government has taken measures to simplify the business environment, reducing bureaucracy, and improving regulatory efficiency. To boost the economy, stimulus measures for investment and innovation have been adopted, such as tax incentives and financing programs. The lesson learned is that fiscal austerity measures, combined with structural reforms to enhance competitiveness and improve the business environment, can help in economic recovery and the resumption of growth. Furthermore, promoting investment and innovation is crucial for driving the economy and creating jobs. By considering the lessons learned from these countries, valuable insights can be gained to deal with economic crises, adapting strategies to the specific needs and characteristics of each context.